Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what is driving investment markets and what to look out for in the days and weeks ahead. Now, a new week and new highs. This melt up in equity markets continues. So if we look at what's happened in the last week since the last video that I made, the stock market in America is up about 0.93%. The FTSE is up about 0.63%. European equities up about 0.23%. But in Japan, they're up about 3.5%. And we've got similar rallies in Asian equities. And a lot of that has come down to the currency exchange rate. So in America, if you remember, the dollar was weakening. We had that turn around slightly. So the yen weakened against the dollar, and that's always good for the Japanese stock market because it's very export orientated. So that means Japanese equities have done particularly well in the last week. But the point is the risk on sentiment is still there and driving markets upwards. And that is largely because of the Fed and central banks being very accommodative. Now, the other thing that markets are happy about is the trade war between the US and China. Today, in fact, as I make this video, later on today, there's going to be some form of ceremonial signing of the phase one version of the trade deal. And nobody knows quite what is in that trade deal, but China and America are going to sign this version of the trade deal. But there was some slightly negative news about the trade deal. Apparently, the tariffs are to remain until after the November election in America, which obviously the market would love it if all the existing tariffs that America and China have imposed were to be removed. So that's not actually happening. So at the moment, markets have hit highs, but they are now starting to sort of wait to see what happens with this deal. But if you go into the UK, the big news was the pound. Now the pound pulled back and actually fell back below the $1.30 mark. Now the $1.30 mark is a very supportive level. And given that after the UK election we saw the pound rally against every other currency, and particularly against the dollar up to $1.35, it's given all of that back and broke below that $1.30 level. And people started to suggest that it might head lower, but there's a lot of support around sort of $1.29 and $1.28. So at the moment, the pound has bounced back just above that $1.30 level. And the reason it fell is because there was news that came out about various different members of the Monetary Policy Committee, which are the 9-team strong committee that make the rate decisions in the UK. And they started to hint that more and more of them might vote for a rate cut as early as this January when they have their meeting. Now, the market had been pricing just a 5% chance that interest rates would be cut anytime soon. Well, of course, that's rocketed to nearly 60% in the last week. So if interest rates are cut, then that tends to put downward pressure on the pound. So that is why the pound broke below that key level. Now, the reason why they are potentially going to cut rates is because there's concern about the UK economy. And in fact, there were some GDP numbers that were released for November. That was just before Christmas in the lead up to the general election that showed signs that the economy shrunk by 0.3%, which was totally unexpected. So perhaps the UK economy is weaker than the Bank of England had thought. So if we do get a rate cut, that will be boosting the economy. There'll be an attempt to boost it, which leads us nicely in a sort of circular motion, talking about recession again. The market has completely priced out the idea that there will be a recession. And we had that, well, last week I talked about the dollar falling and was that front running the Fed and would they cut interest rates? Now, the one thing that could knock the euphoria surrounding equity markets is if we get signs of a recession in the next sort of couple of months. And if in particular at the end of January, the US GDP numbers, so the economic numbers, do miss, so keep an eye on that, because there are signs that the economy is still slowing in America, even though lots of people have said we've hit the bottom and things are rebounding. There were some payroll numbers, so some job numbers that came out at the end of last week that missed expectations, so they were on the low side. So there is a potential that we could get a surprise later in the month when it comes to economic numbers in the US. Now, it won't be a recession, because don't forget, a recession is where you get 2 consecutive quarters of contraction in GDP, so we won't be there yet, but it could set up for a bit of a wobble. But at the moment, everybody is happy The market is euphoric. It seems to be that everybody's now piling in. If you look at the analysis of whether it be retail investors, that's DIY investors, whether it's institutional investors, they seem to all finally have pushed all their chips into the market in that fear of missing out. And when we get to that stage, that can be a worrying sign. And if the market turns, it could be quite aggressive. But at the moment, there are no signs that the uptrend is about to break just yet. So the one thing we've got also coming up is the earnings season. So just like every earnings season that we get, where companies start to release how much money they've made and their profits, they will be scrutinized. So we'll be looking to see whether the profit margins and the level of earnings from these companies is actually increasing. Because the worst thing, if we get signs that they're actually contracting because of the economy, then that could also undermine the market. So that is it for this week on Damien's Midweek Markets. If you want to get in touch, you can do the usual way, damien@moneytothemasses.com, or via Twitter, moneytothemasses with the number 2. And don't forget to join our Facebook group and follow us on Instagram.